On Wednesday, the Federal Reserve announced it would be raising interest rates for the first time since 2018. And this 25 basis point hike was largely expected, but it does signal a larger shift in Fed policy that real estate investors should be paying attention to and really need to understand. This is going to impact the housing market going forward, and I hope you stay tuned for this episode where we're going to talk about interest rates, why they matter, and where mortgage rates might be by the end of 2022. What's going on, everyone? I'm Dave Meyer, VP of Data and Analytics at BiggerPockets. Before we jump into this really important news for investors, please give this video a thumbs up and subscribe to the BiggerPockets YouTube channel. And if you're feeling extra generous, follow me on Instagram at The Data Deli for more news and financial information. All right, first, let's talk about what exactly happened yesterday. What it means when the Fed raises rates is they're raising their target for the federal funds rate. The target rate doesn't actually impact consumers directly. It's the rate at which banks borrow reserve balances from each other. But when this rate rises, it sets off this domino effect that eventually impacts consumers. Essentially, when the Fed raises their federal funds rate, it costs banks more to borrow. And in turn, that makes it more expensive for them to lend to consumers. And the costs that the banks are incurring, of course, are passed along to the consumers. Why are they doing this? Why is the Federal Reserve raising interest rates right now? Raising the federal funds rate is a way to fight inflation. The definition of inflation is often described as too much money chasing too few goods. So to fight inflation, you try to reduce the amount of money circulating in the economy. If inflation is too much money chasing too few goods, if you can reduce the amount of money chasing those goods, that could tamp down inflation. And the way you reduce monetary supply is by increasing interest rates. As interest rates increase, businesses and individuals, they're less inclined to borrow money to make big purchases. So for a business, that could be expanding into a new market or sector or hiring new people. For an individual, that might be borrowing money to buy a new car or a new house or take out student loans, stuff like that. So raising interest rates is a key tool to fight inflation. And yesterday, the Fed demonstrated they are taking a very aggressive stance against inflation, and they're going to raise rates a lot, which I will get to in just a minute. But first, I kind of want to just talk about why this even matters in the first place. And first and foremost, rising interest rates, it's sort of a dance, right? So rates should go up. In my opinion, at least, they need to go up to fight inflation. We're seeing inflation at 7.9% right now, which is really bad for the entire economy. So rates need to go up, in my opinion, because 7.9% inflation is just not acceptable. It's really bad for the economy. But rising rates also puts the economy at risk for reduced GDP growth or even a recession. So why is that? Well, it's what we just talked about a minute ago. When interest rates rise, less businesses and less people borrow money to spend. And when fewer businesses are expanding and fewer cars are being bought, the reduced spending can hurt economic growth. Spending is very, very important to economic growth. So this whole thing is a little bit of a dance. You want to raise rates enough to tamp down inflation, but not so much that it sends the economy into a recession. And this delicate balance is why people like me watch the Fed's moves so closely. Everyone wants to know how they're going to balance their dual responsibilities of fighting inflation, but also promoting economic growth. So next, let's just talk about what actually happened in this March meeting. First, as I said at the beginning, there was a 25 basis point hike, and a basis point, if you're not familiar, is 0.01%. So it's basically 0.25% interest rate hike. And this was expected. It's not really that interesting for people like me or anyone who watches what the Fed does really closely. Instead, what I really like to look at from these meetings is known as the dot plot. And the dot plot, which you can see here, shows how the people involved in the FOMC meetings, these Federal Reserve meetings, are actually thinking about interest rates and where they should be at the end of the year. These are the people who are actually making the decisions about interest rates and where their heads are at about interest rates. And what you can see from what was released yesterday, the median is now about 1.875 for the end of 2022. Remember, right now, or actually 2 or 3 days ago, we were near zero. So that signifies a very aggressive series of rate hikes throughout the rest of this year. So you should expect continuous rate hikes in 2022. And to be honest, this has been expected for a while. A lot of people have thought there could be 6 or 7 rate hikes since at least January. So this is largely in line with what the market has been expecting, and the Fed has basically confirmed that in their most recent meeting. But after 2022, it's interesting because interest rate hikes are projected to slow down a bit, where the rate will be around 2.8% in 2023 and 2024. And then actually, most members of the FOMC see it coming down in the long run to about 2.4%. And for context, the upper limit of the Fed's target rate was about 2.5%. That's the highest it's been since the Great Recession. And that's what it was at in 2019 before the COVID-19 pandemic. And so the Fed is planning to go higher than we've seen since the Great Recession, but then to bring it back down a bit once inflation is hopefully in the 2 to 3% range, which is what the Fed targets. From what I'm seeing in this data, if you're afraid of seeing huge mortgage rates of 7+%, don't be just yet. There is a long way to go before we get to that level. The data just doesn't suggest at this point that we're going to see mortgage rates go that high. But that does beg the question, where are mortgage rates going to go given this recent information? This is obviously a super important question for real estate investors, and I have to tell you, the truth is the Fed's target rate doesn't really impact mortgage rates that directly. If you check out this chart, you can see that the relationship between the federal funds rate, which is the green line, and mortgage rates, which is the blue line, is not that strong. There's not much of a correlation between them over the last 10 years. I know that's confusing. We can get more into that another day, but that's just the reality of what we've seen since the Great Recession. But what about that red line? The red line is the yield on the 10-year US Treasury bond, and that has a very strong correlation with mortgage rates. And that is the number we need to watch over the coming years. And bond yields, yes, they are impacted by the federal funds rate. So indirectly, this is going to impact mortgage rates. But bond yields are also impacted by many other things like geopolitical events, what's happening in the stock market, and so on. And I'm not a bond yield expert, but given recent activity, I wouldn't be surprised to see yields hit 2.5% this year, or maybe even a bit higher. And with that, I think mortgage rates for a 30-year fixed rate owner-occupied property could be around 4.5 or 4.75% by the end of the year. And for historical context, this is still pretty low. Prior to the Great Recession, as far back as I have data, I can't even see a time where mortgage rates were under 5%. But it does represent a significant departure from where we've been over the last couple of years, where we've seen rates even below 3 at some point, which it was the all-time low. Before the Great Recession, rates, like I said, were never below 5%. And so just keep that in mind as an investor going forward, that rates are going up, but in the historical context, it's still really, really low. Lastly, let's just talk quickly about what this all means for the housing market and housing prices. This news is going to put downward pressure on the housing market. It's pretty simple. Rising rates decrease affordability, which lowers demand. And in normal times, in a more normal or healthy housing market, this would have a pretty immediate impact on the housing market. But these are not exactly normal times. And remember, there are other forces driving the housing market right now, like super high demand, which is coming from millennials reaching peak family formation years, increased investor activity, and increased demand for second homes. And at the same time, we're also seeing low supply. Just the other day, Redfin announced that inventory had hit all-time lows. So when demand is high like this and supply is low, that puts upward pressure on the housing market. So you're going to continue to see this sort of balance and these counteracting forces. On one hand, we have interest rates putting downward pressure on the housing market. On the other hand, we have both supply and demand putting upward pressure on the housing market. And because of that, what happens next is pretty hard to predict. After all, we have a war and a humanitarian crisis right now. We have super high inflation and rising interest rates, but so far, the housing market has been unaffected. Inventory is at all-time lows, demand has remained really strong to date, and as of yet, the housing market has shown no signs of slowing down. Although I really like to sort of project what might happen, and if I had to make a guess, I would say that housing prices are going to continue to grow above average rates through the summer, and then come back to slower rates, maybe 2 to 5% appreciation year over year, or maybe even flatten out completely. That's my best guess. And although I like to make these guesses to help all of you understand what's going on in the economic climate, in uncertain times like this, I personally, in my own investing, I don't really try to time the market, and I don't advise that you do either. Instead, I think the important thing as an investor is to look past the uncertainty. Because in my mind, although the next year or two is pretty uncertain, I think it could really go either way, honestly. The long-term growth, on the other hand, my idea of what the market's potential for long-term growth is remains completely unaffected. I think, yes, short-term investments to me are risky right now, but I've never been a house flipper, so take that with a grain of salt. But long-term rental property investing remains a great option, and it is one I am going to continue to pursue to hedge against inflation, because if I do nothing, if I leave my money in cash right now, I'm going to be losing somewhere between 5 and 10% of its spending power this year. So instead, even though I know that there is some chance that the housing market will flatten or even decline a little bit in the next couple of years, I still think that investing right now is the best way to set myself up for a very strong financial future 5+ years down the road. Thank you guys so much for watching. I'm Dave Meyer. If you have any feedback for me, questions, or just want to connect, you can hit me up on Instagram at The Data Deli. And if not, I will see you here at the same time next week. Thanks.